Hello to all traders and welcome to this webinar provided to you for free by FXPRIMUS. I hope you're doing well wherever you're watching us from today. My name is Stavros Tousios and I'm the market specialist at FXPRIMUS here in Limassol. FXPRIMUS is globally acclaimed for offering one of the fastest and most secure online trading environments available anywhere in the Forex industry. Our extra measures in safety have positioned us at the front runner in responsible trading, and we are now setting new standards in safety amongst our counterparts in the Forex industries. The company enables clients of all experience levels to trade over 120 instruments, including currency pairs, commodities, CFDs, and also indices. FXPRIMUS sets the benchmark in safety for its industry-leading safety mechanisms. We were the first to offer client fund insurance coverage of up to 2.5 million euros per claim and offer third-party monitoring for client withdrawals by boutique client trusts. We are going the extra mile to offer you protection unseen anywhere else in the industry. Now a little bit about me. I have traded professionally for over a year or 2 years and successfully for over 2 or 3 years, and just decided to take this a step further, entering the Forex market here in Cyprus. Decided to do so that I can pass on my knowledge to people that are starting or people that haven't started or people that have some experience as well. So today we will look at a very important aspect of trading, technical analysis. Now, before we go ahead, please give me a few seconds to read our risk disclaimer. Please note that Forex trading and trading Forex leverage products involves a significant level of risk and is not suitable for all investors. Before undertaking any such transactions, you should ensure that you fully understand the risks involved and seek independent advice as necessary. Any opinions, news, research, analysis, prices, or other information contained on this webinar or linked from this webinar are provided as general market commentary and do not constitute investment advice. FXPRIMUS or its representatives do not accept liability for any loss or damage, including without limitation to any loss of profit, which may arise directly or indirectly from use or reliance on such information. Now back to our core topic, technical analysis. If you're planning to trade or already trade or have traded and was trying to figure out why the markets are moving or behaving the way they do, it was all a part of technical analysis. If you know what technical analysis is, good. In any way, you still have a lot to take from this free webinar and also get to ask any questions you may have at the end. Okay, let's kick this off then. Now, before we even see our agenda for today, I'm going to start with explaining what exactly technical analysis is. Technical analysis is the attempt to forecast currencies prices, but not, of course, limited to, on the basis of market-derived data. Technicians, or also known as quantitative analysts or chartists, usually look at price, the volume, and a number of psychological indicators over time in order to identify trends and patterns in the data that indicate future price movements. So today we're going to talk about charting and how data are represented. There is different kinds of representations and also formations that can be found over time. We'll talk about the basic technical tools like support, resistance, patterns, and the Fibonacci, as well as a number of indicators that I use when I analyze the markets. Closer to the end, we will talk a little about Dow theory, the different market types, and the market's philosophy. I'll speak about Elliot Waves and market cycles, as well as the use of Fibonacci and how the number of Elliot Waves reflects the Fibonacci sequence. Now, on to our first page, charting the markets. There is different ways that the markets can be charted. Actually, chartists use bar charts, candlesticks, or point and figure charts to look for patterns which may indicate future price movements. We're not going to look at the point and figure charts today, just the bar charts and candlesticks, Japanese candlesticks. Now, chartists also analyze volume and other psychological indicators, okay, which is pretty much the percentage of bulls versus the percentage of the bears. Strict chartists, just to make sure that you know, they do not care about the fundamentals and the fundamentals development at all. Now let's see at the drawing bar first. This is the OHLC chart, which means open, high, low, and close. Each bar, of course, is composed of 4 elements. Okay, note that the here the candlestick body is between open and close. Okay. And of course, this is the higher end of the price, and this is the lower end of the price. This is a bullish candle because the open is below the closing price. Vice versa for a bearish candle. You could actually print this next two slides to see them more clearly. Okay, now again, this is another representation of the OHLC chart. This is a bar chart. Okay, this coming right from MT4. The other type of chart is the Japanese candlesticks, and this is the most used one actually. It also have, of course, an open, high, low, and close, but the representation is different. Okay, you can see, you can choose the color, of course, but you can see that the opening and the closing price between the two, there is a bar. Okay, that is filled with color, a color that you can choose. Now, here's some good tips for the Japanese candlesticks. Okay, as everything else in the market, also the Japanese candlesticks, they do form patterns. Okay, I'm not sure if many of you have identified many, or if you know if there is many, but I can tell you for sure that there are many Japanese candlestick patterns. Here I have collected some information in the next two slides about the ones that I think they're most important for you to understand and know, and also what rules, according to the books, are valid for those formations. This first one is called a doji candle, or the indecision candle. Okay, and in this one we have an equal strength of buyers and sellers. Okay, so if this is an hourly candle, it means that during the hour the price reached this low level and also this high level, but at the end it closed exactly where it opened. Okay, now the rule of thumb is that if you see this pattern at a very exhausted uptrend, the rule is that you can it's a sell signal, and it's the opposite for the bears, of course. Okay, when the market is trending downwards and you see this candlestick, is a signal to buy. But of course, this has to be confirmed with an oscillator and maybe other candlestick patterns. Now, the next one is the gravestone doji. The open and close are at the lower end of the candle. Okay, this also has the same rules as the doji candle. And the other one is the dragonfly doji. The open and close on these ones are at the higher end of the candle. Okay, and also this is a reversal signal. Okay, now note that for those two, another rule of thumb that you can find in books is that if the small bar, okay, if the bar is small, this one, and the wick is 2.5 times bigger than the bar, okay, then this is a stronger signal. Okay, now continue on to the Japanese candlesticks. This formation is called the morning star, and this one is called the evening star. Okay, the rules are that if you see this formation, you can buy at the bottom or sell at the top of the trend. Okay, now the stronger reversal if the current candles close above 70% of the previous candle. Okay, so if this candle is 70% above this one, then this is a very good indication. This is a bullish signal. Okay, next we have the bullish and the bearish engulfing. This is when, of course, the current candle engulfs, shadows with few words, the previous candle. Okay, this is also a reversal signal. Okay, now the stronger the signal if the candle shadows more than one candles. Okay, and last we have the bullish and the bearish harami. Again, a reversal signal. You can sell at the top and buy at the bottom of the trend. Now, we have a stronger signal if the candle close of the current closes reaches the previous one. Okay, so right here. Now let's go on to the next slide where I'm going to talk about some basic technical tools. Okay, the support and resistance, the trend lines, moving averages, price patterns, some indicators, and also the Fibonacci. Now, starting with support and resistance. Support and resistance lines are likely indicate end of trends, okay? And they are based on market psychology. There are, of course, different types of support and resistance, like Fibonacci resistances, Camarilla, or the flow trader. But we're just going to look at identifying the levels first, okay? Now, for example, this down here is a support level because price has bounced over this price level before, second time here and third time here. So this is a support level. The top is the resistance, okay? The resistance results from the inability of the price to surpass prior highs, okay? And the support, of course, results from the inability to break below two prior lows. Here, for example, we have seen the support breaking, okay? Now, what was support becomes resistance and vice versa. For example, let me just grab my, there we go. So we see this level is a support and it's breaking down, right? Now, what was a support becomes a resistance. So exactly at this point right here, when price reaches that level and this level is rejecting price, then this is when this becomes a resistance. We seem to have a sound problem. It keeps going. 1 second. Let me just check my connection. Okay, I'll connect the two networks, make sure that the signal is not going down. If you keep experiencing any issues, please let me know. Okay, so I guess we can carry on now. So let me just drop the tool here. Now, in terms of trend lines, when a diagonal line connects two or more price levels, this is when we have a trend line. There are three basic kinds of trends. Okay, there is the uptrend, where prices are generally increasing, as this one over here. There is a downtrend, where prices are generally decreasing, as this example right here. And we'll have also the support and resistance when we have a trading range. But within the trading range, of course, we could have a trend line. We could have a trending market onto the, if we look at lower time frames. Now, the simple moving average. A moving average is simply the average price over the past number of periods. Okay, they are used to smooth out fluctuations of less than the amount of periods that you have set your charts to look at. There's different types of moving averages, the exponential, the simple. We're just going to look at the simple for now. Mostly they are used also as an indication of where the trend is actually heading to, or if a trend is going to hold for any longer or not. In terms of price patterns now, technicians look for many patterns in the historical time series of prices. These patterns are reputed to provide information regarding the size and timing of subsequent price moves. But don't forget that some say that these patterns are illusions and have no real meaning. In fact, they can be seen in a randomly generated price series. Let's start with the patterns then. And the first one that I think is very important to know is the head and shoulders pattern. Okay, this formation is characterized by two small peaks on either side of a larger peak. So this is the left shoulder, the right shoulder, and the head. Now, the bottom one is called normally an inverse head and shoulders pattern. Okay, we again have the left shoulder, the right shoulder, and the head. This signifies when we have a head and shoulders pattern, whether this is the normal one or the inverse one, this normally indicates a reversal in the market. Okay, here's a real example from a head and shoulders in the markets. We can see here the advanced macro depth, the daily charts. You will be able to notice the left shoulder over here, the head, and also the right shoulder. This is the neckline. Okay, and once this neckline breaks, we have a reversal over here. This is a retest. I said earlier that support becomes resistance and resistance becomes support. So from this trend down there up to the head, we have had the reversal once the right shoulder was confirmed and formed. Guys, if you have any questions, please keep them for the end. Deepak, thank you. This is a different formation called double tops and bottoms. These formations are similar to the head and shoulders formation, but there is no head in this case. Okay, they are both again they are assumed to be a reversal pattern with the same measure implications as the head and shoulders pattern. And this is an example again. So we see price breaking this level, then retesting the support and moving higher. Okay. Then we see a small correction in the market, and then we see market going back to the same level as it was previously a few weeks ago, and creates a strong support level. Note that every time the price is moved and it's rejected, then the stronger the level of the support or the resistance becomes. Now what happens after this? Then we had a bounce going upwards and then price went back lower. This exactly is what is called a double bottom. Okay, vice versa, the same for a double top, of course. Now triangles. Triangles is a very, very, very big topic, but I'm not going to go through a lot of things. We're just gonna touch base on those. Okay, so there is 3 different types of continuation formations: the ascending triangle, the descending triangle, and also the symmetrical. Now, typically, triangles should break out about half to 3/4 of the way through the formation. Okay, normally this is also recognized as a wave within the ascending triangle or descending. Okay, so where it's called an A, B, C, D, E pattern. Okay, price will bounce around 5 times around within these levels and then break out either up or down. Okay, and this is of course the symmetrical, where we see there is no bullish or bearish momentum into this certain formation. So here's we can see an example from the Dow Jones. The first triangle actually we see is right here, this formation right there. And the second triangle again is the other formation right here. Now next is the rounded tops and bottoms. Rounding formations are characterized by a slow reversal of trend. Okay, so normally we will see the price getting exhausted moderately, okay, gradually, and then we'll start seeing a small pickup. This is the same for the bottom and the top. And there is an live example from a stock. It's exactly as we said right here. We can also notice a triple bottom right here, but I'm not just gonna go into this now. I'm gonna focus on the rounded bottom example. Okay. Now, technical indicators. There are literally hundreds of technical indicators, and they all used to generate buy and sell signals. Okay, we're only going to look at a few that I am using to chart the markets. Okay, those are the MACD, which is the moving average convergence divergence indicator, the RSI, relative strength index, and BB, or as called the Bollinger Bands. MACD was developed by Gerald Appel as a way to keep track of a moving average crossover system. Appel defined MACD as the difference between a 12-day and 26-day moving average. A 9-day moving average of this difference is used to generate signals. Now, when the signal line goes from negative to positive, a buy signal is generated. When the signal line goes from positive to negative, a sell signal is generated. Now, MACD is best used in choppy markets and is subject to whipshows, in and out rapidly with little or no profit. Here is an example. Okay, this is the MACD. So when price is, when we have a crossover of the price, we see that could generate a sell signal. Okay, this is the two line. This is a histogram, and this is the two signal lines, the two different periods. Okay, now the MACD is useful for trend change and continuation patterns, less used for ranging markets. It works best in breakouts as the moving averages they rise tremendously. Okay, or we have the crossover above the zero line. EMAs and our moving averages are of the difference between the two moving averages. Now, with the MACD, we have three different types of signals. We have crossovers, divergence and convergence, and also, of course, the dramatic rise, or you can call it the breakout. Now, looking a little bit deeper in this, MACD convergence, let's see what it is. We have a bullish convergence when price is making higher lows and the oscillator or the histogram making lower lows. So this example right here, the first one on the picture on the left side. We have, in the contrary, we have a bearish convergence when price is making lower highs while the oscillator or the histogram are making higher highs. Note that it can be either of them, the oscillator or the histogram. If it's both of them, then this is a better signal. Now, MACD divergence. We have a bullish divergence when price is making a lower lows while the oscillator or the histogram is making higher lows. Okay, over here. And the bearish one when the price is making higher highs and the oscillator or the histogram are making lower highs. This formation, the bearish divergence, is normally the most seen ones in the markets, and it can be combined also with the head and shoulders formation we saw earlier. Okay, so imagine this would be the left shoulder, the head, and the right shoulder, and we would see a bearish divergence right here. Now let's go to the RSI, Relative Strength Index. The RSI was developed by Wells Wilder as an oscillator to gauge overbought and oversold levels. The RSI is a rescaled measure of the ratio of average price changes on up days to average price changes on down days. The most important thing to understand about RSI is that a level above 70 indicates a currency pair is overbought, and a level below 30 indicates that it is oversold, because the price it can range from 70 to 30. Okay, now note that also the 50 level line is used to identify whether we are in a bullish or bearish markets. Sometimes the 60 and the 40 levels are used for that as well. Now, realize that currency pairs can remain overbought or oversold for long periods of time. Okay, so RSI alone is not a great timing tool because it's lagging. Okay, it follows price. It's always good if you combine indicators together. So here's an example. Okay, so we'll have the 50 line, we'll have the 30 line, and also the 70 line on the top. Here we see the price is bouncing at the 70 level and it's going lower and down. Here we see that price is going is oversold right here, and it remains below the 30 level for quite a bit. Now, a little bit more about the relative strength index. This is mostly suited for reversals, okay, and combined with support and resistance levels rather than continuation patterns or breakouts. The RSI is used on 14 periods, but most traders use it also on the 6 and 9 periods as well. But it depends on the time frame that you use, and also the markets, whether the market is breaking or trading or sideways, and also on the pair, because some pairs are more volatile. Now, as with the MACD, the RSI can be used to identify divergence and convergence levels. When divergence or convergence appear on both indicators, the signal produced is very strong. Let's go into the Bollinger Bands now. The Bollinger Bands were created by John Bollinger, formed FNN technical analyst and regular guest on CNBC. The Bollinger Bands are based on a moving average of the closing price. There are two standard deviations above and below the moving average. A buy signal is given when the currency price closes below the lower band, and a sell signal is given when the currency price closes above the upper band. When the bands contract, that is a signal that a big move is coming, but it is impossible to say if it will be up or down. In my experience, the buy signals are far more reliable than the sell signals. Here's an example of the Bollinger Bands. So the middle line is called, it's just a moving average, okay? And the lower band and the upper band, they are two standard deviations away from the middle line. It's purely mathematical and statistical. So we see that when the bands contract, then a breakout will follow, okay? Now, the Bollinger Bands measure market volatility. They can tell us when price is in an extreme condition, trending, consolidating, speeding up, or slowing down. Price formations can be identified to indicate when the market is ranging, which means there is no clear direction and the Bollinger Bands are flat, and the volatility control. When the market is trending, where we see continuous upward or downward trends, and the Bollinger Bands are sloping, the volatility, of course, is not neither controlled or uncontrolled. And we also indicate the market when the market is breaking. Okay, and the contraction, we'll have the breakout first, we'll have the contraction first, then some expansion and the breakout. And this is when the Bollinger Bands actually narrow, and then we see the breakout. Now let's touch a little bit on Dow theory, so we can talk about market cycles and understanding a little bit the Fibonacci numbers. So Dow theory addresses technical analysis, price action, and the market's philosophy. Charles Dow said that markets discount everything, and this is reflected in the prices. Dow theory tells us that Bollinger Bands do, pretty much, that there are three types of trends: up, down, and sideways. Trends can be large, major, or small, minor, including price corrections that in no way are not indicating price reversals. Now, Dow's theory indicates that the trend starts following an accumulation phase, then the market's participation, and then the price extension. Okay, this is when we see the price being overbought, or maybe the exhaustion of an uptrend or a downtrend. So here we see a nice example of the Dow Jones, and actually I've created this chart just for Dow Jones himself. So right here we see the accumulation phase, okay, because we see the markets are moving a little bit slow and there is no volatility. When volatility increases and liquidity, I suppose we have the markets participating a little bit more. There's more buyers in this scenario, but this is still the early stage. Then we see a correction of the market, because obviously, some people want to start taking profits. We see again the markets participating. It could be the same people with bigger volumes or new market participators. And this is the middle stage. We again see a correction, and then we'll have the extension stage of the trend. Okay, where we see the price will reverse, and this is called the distribution phase. Okay. Now, as we saw this correction, the small one, we are expected to see a major correction right here. Okay, and this is when we are having one full cycle. So this move up here and up to this move down there to the 23.25, this is one cycle, and It could be also called a wave or a leg. Dow urged that index market prices must confirm each other. For example, Dow Jones and S&P confluence, as long, of course, they are in the same sector, two equities in the same sector. Now, volume must confirm the trend. For example, an increase in price should reflect an increase in volume. When volume and price diverge, momentum is lost and a possible reversal is coming. Trend is clear until a reversal is confirmed by other means. You can use the RSI, the MACD, or any other indicators. Dow's theory says that when the markets go from accumulation to distribution, a trend ends and a new trend starts. And this is the accumulation followed by market participation. Now, cycles, and we're going to look at time and price, because most of you do not look at the time, you just look at the price. The phase from accumulation to distribution and correction is called a cycle, as mentioned just a few seconds ago. Cycles are not consistent, okay? And they're not accurate or efficient. They contract and expand depending on momentum, strength, or weakness. Now, if the momentum is strong, we will see extensions. If the momentum is weak, we will see corrections. Hence, we'll have even minor cycles, okay? Now, momentum is velocity times mass. In our case, because we're in the financial markets, this will be the speed of the market's order times the volume of the market. Okay, cycles can be timed from cycle low to cycle high and cycle a lower high. So here's an example. We see the Dow theory here being applied. This is the same chart as we saw before. Okay, but here I'm just pointing out that price is moving, volume is increasing with price, as this is a requirement. Okay, volume must confirm the trend. And we'll say when volume and price diverge, momentum is lost. So here we see the price moving higher, but the volume is decreasing. Okay, and this is when we'll have a price reversal. Right here, that bit exactly is called the end of cycle. Okay, so we'll have the accumulation stage, market participation, extension, and then distribution. A correction, and then a new cycle starts right here. Now, I want to talk about Elliot Waves a little bit, because Dow theory tells us pretty much this. It's all about the cycles. Now, Elliot said that identified actually different patterns, okay, 13 in total. And he identified 13 recognizable patterns. All patterns reform to identical patterns of larger size, and they are fractally similar of increasing size. Now, this is a basic 5-wave idealized pattern. Okay, so we'll have wave 1, wave 2, wave 3, wave 4, wave 5, and then A, B, C. So imagine this as the uptrend, accumulation, stage 2, and then extension, and this is the correction phase. Okay. Now, impulse or motive waves are denoted by numbers from 1 to 5. Corrective waves are denoted by letters, which is the ABC. That's why this is called a correction. Now, since we saw the Dow theory, how important is price and time, as well as the Elliot waves and how they are applied by using the Dow theory, I want to introduce the Fibonacci. Okay, Fibonacci numbers represent a series of numbers in which each subsequent number is the sum of the previous one. For example, 1 plus 1, 1, 1 plus 1, 2, 2 plus 1, 3, 3 plus 2, 5, etc. Fibonacci ratios now represent a series of ratios that come from the division of any number in the subsequent by the following, or next number, or the one after. Elliot wave theory says that because markets unfold in sequences of 5 and 3 waves, the number of waves that exist in the market's patterns reflects the Fibonacci's sequence. I will repeat this one more time. Elliot wave theory says that because markets unfold in sequences of 5 and 3 waves, the number of waves that exist in the market's patterns reflects the Fibonacci sequence. Now, Fibonacci retracements are possible areas of support or resistance after we have a pullback. They are draws from low to high in an uptrend, high to low in a downtrend. This is how they are drawn. Levels to remember are 0.146, 0.236, 0.322, 0.50, 0.618, 0.764, and 0.854. Now, Fibonacci extensions are possible target areas to take profit, support, or resistance. So this is the difference, okay? We'll have retracements and extensions. Retracements are support and resistance after a pullback. Extensions are target areas to take profit. Now, they are drawn from low to high to the retracement in an uptrend, high to low to the retracement in a downtrend. The levels to remember are 0.618, which is the golden ratio, the 1, which is 100%, 1.236, 1.618, 2.618. And here we see how this actually is applied in the market. Right here, I pulled a Fibonacci retracement. Let me use my spotlight or a pen. Right here, I draw a Fibonacci from here up to there. Okay, and I can identify that the price moved from this level up to here, and then it dropped. It corrected down there. Okay, it corrected right at the 65% Fibonacci retracement, or the 0.618 as otherwise called, near to. Okay, now what I did after is I took my Fibonacci extension tool, okay, and I drew from down here again up to this first level of accumulation and down to the retracement level. And I see price extending first to the 1272, then is correcting again down to the 0786, and then I see a further extension to the 161.8. Okay, that follows another correction right here, and then lastly I see the further extension at this level, which is the 261.8. Okay, and this is how the Fibonacci retracement and the Fibonacci extension work. One second, let me delete this. So, okay, I think this is all. It comes from my side. I am done with the presentation, and I am now ready to take any questions. Apologies again for the connection issues. I connected to 2 different networks to make sure that we're not going to have any issues. So please feel free to ask your questions. Okay, I have some question from Fayaz. When exponential moving average is used? Okay, the exponential moving average, Fayaz, is pretty much something that will show you how the markets are going to behave sooner than a simple moving average. Okay, most of the times it's not good to use the exponential one because it might give you false signals. Okay, don't forget all the indicators, including the moving average, are lagging indicators. All of them follow price. So the number 1 indicator you should always look at is candlesticks. Okay. I have another question from Deepak. Have you used supply and demand zones to make an entry or exit position? Of course, Deepak, supply and demand zones are pretty much support and resistance. Okay, and of course you can use them to enter or exit a position. But this saying this, that requires you can't just expect or assume that any time you hit a support to buy or any time you hit a resistance to sell. There have to be other indications as well. Fayaz, give me an example on the moving average. Okay, 1 second. Let me just change my screen. Okay. Fayaz, can you see my screen? So let's just open this as an example. Let me just take out all the indicators. Okay, and we have the MACD and the RSI as I showed you earlier. Now I want to add the MACD at the moving average. This is a simple moving average of 200. Okay, if I draw the same, but I change it to exponential, you will see that it reacts faster. Okay, so maybe it's better if we even go lower. Let's go to 50, for example. Let's go to 50 in both and maybe change color just to see how this works. So you see, if you use the exponential, you get signals earlier than the market has moved. Okay, which means most of the times that this is not good because you might enter the market much earlier than anticipated for a good signal. Okay, so 80, I have a question from 80. How much more importance should be given to technical analysis versus fundamental, and why? Okay, this is a very good question. 80. My view on this, because I love technical analysis, and what technical analysts say is that fundamentals are part of technicals. Okay, why? I will explain to you very simply. If you look at the daily chart, we see a support level down here. We see the market moving up. Okay, correction, and then moving up. If I'm a technical analyst, I would know that once this level, 1 second, let me take the pen. They would know that price came over here. When this level breaks, and that level right here is where I can buy. Okay, I know this because I'm a technical analyst. No fundamentals can tell me that I can buy here. Okay, and then look, if I bought here, price will go and it will create this huge uptrend and a huge profit potential. And then you say, but where do I take profit? So that's what a fundamental analyst wouldn't tell you, because they don't know. If we suppose this is your first level up and this is the first correction, you can simply see that a good level could be the 1.17, for example, if you want to go like the furthest one, right? I can tell you this because I use the Fibonacci extension. Now, fundamentals on the other side. Let me just clean my charts for a second. Fundamentals on the other side, you have to go back and look at the 1 hour or even lower, 30 minutes or something. Okay, you will see a small move of maybe 10 pips, 20 pips, even 50 pips when the NFP is due. You will see the market going, for example, here, the market is moving down, but this is not what will set the tone for the next market move. Okay, it is not. But even if it is, again, the market will move according to technicals, not to fundamentals. Okay, technicals are the #1 priority. I hope this makes sense. Felix, I have another question. How can technical analysis be used to analyze the effects of politics? For example, NAFTA, trade tariffs, Trump firing staff. Okay, Felix, you can use technical analysis when there is news coming out, for sure. But each event has a different effect on the market, and of course on different pairs. Okay. Now, saying this, the only way you can use technical analysis to identify opportunities, I would say, not to analyze the effects of the politics, would be to to identify support and resistance levels, and try to understand the meaning of the actual of the political event. Okay, for example, the trade tariffs had a significant effect on the dollar. The dollar was very mixed. Okay, I would say normally when there is something bad for the US dollar, then everybody will turn to safe havens, yen, gold, and of course the euro will rise because the dollar is falling. Okay, when there is an interest rate decision, for example, and the interest rates in the US goes up, then it means that the dollar will rise in price. Okay, because it's more attractive for investors, and investors will buy US debt because they can make more profit on it. I hope this makes sense, Felix. AT, again, back to your question. The point is that every time a politician opens up his mouth, trends based on technical analysis could just reverse regardless any technical projection. Yes and no, AT, and I will explain you why. If you're a technical analyst, you do not only look at the 5-minute, the 10-minute, the 15-minute, or the 30-minute charts. You have to look at the wider market sentiment. And in order to do so, you have to look at different time frames, okay? Larger time frames. Look at the 1 hour, the 4 hour, the daily, even the weekly sometimes, right? As I said, 15 minutes. What do I see? I see euro dollar going up, okay? This is what? This is 50 pips up, 60 pips up. Okay, it's good for intraday trading. It's good for intraday trading. Okay, hold on, we had a delay here. Okay, we see a price moving down now. Okay, something like 30 pips. This is intraday on the 15-minute. But look, if you look at the hourly effect, it's not much. If you do at the 4 hours, probably even nothing. Okay, and the daily, what is the effect? The effect on this? Nothing. If you simply pull a trend line right here, you see, this is what you want to look. You can pull another trend line here. This is what you want to look. Okay, and then you go closer, you go to the 1 hour. You see, it's very far. What is the other thing you can do? You can draw your trend line here. It's more like a support. The most active level is over here. Okay, you see. So if we see this breaking, then price will probably bounce right here or break that level, and then we'll move down here. It's simple as that. So the fundamentals, yes, will have an effect intraday, a very few pips. But if you're a technical analyst, you should check all time frames, not just one. Okay, another question. You mentioned earlier that RSI settings vary with the time frame. If we are checking the 4 hour or 1 hour times, what is the best setting for RSI? Okay. The RSI really depends. It's not just the time frame, but it also depends on what currency pair you are looking. Okay, so there is a few factors you need to look at. First is what pair, because the volatility matters. Okay, you need to also check at the market state. For example, is there a lot of liquidity in the market? Yes or no? Because the New York session and the Asian session are completely different. Okay, now if we take, for example, the euro dollar on the 1 hour, because this is the one pair that has the greatest volumes of all, okay, you can use the 14 and also the 9 because it could give you earlier signals. But on the 1 hour, I wouldn't go below 9. Okay, and you see there is an oversold level here. Now remember what we said about divergence and convergence? This is what we have right here. Price goes up, but the RSI indicator goes low. And what we see? Price moving lower. Okay. Now, if you confirm this with the MACD, can you confirm this with the MACD? This is a very good signal. Well, let's see where price is. Price actually, we see the volume decreasing on the histogram. Okay. So it's a good signal. But again, you have to confirm with a 4-hour chart too. Okay. The more confirmations you get, the more reliable your signal will be. Okay. So never go below 9. In choppy markets, for example, dollar, pound, yen, okay, is very volatile and the moves are very, very, very sharp. Never go below 14. Okay, hope this helps. Felix, no problem. How do you explain the last US reaction to NFP data last week? Okay, let's go and have a look. So we are Friday 9th. Friday 9th. We want to find Friday 9th. Okay, I think we are right here. Okay. Am I looking at the right candlestick? So euro, yen. This is 3 o'clock. Dollar yen, 3 o'clock on the 12th. No, this is not the 12th. Sorry, we'll have to go on the 9th, right? So the 9th. Okay, we are over here, correct? So dollar yen went up. Okay. So the reaction is correct. From what I remember, the NFP headline numbers came much better than expected. Okay, so everybody always trades the headline numbers. Now we see this move carried on going up, and this was because the inflation expectations and also the interest rate expectations, because when we get good numbers on the NFP, it means that the economy is actually improving. Okay, when the economy is improving, then there is no inflation pressures and also interest rate pressures subside. I do remember also that the unemployment rate came out worse than expected, but the same as the previous result. And then with the wages didn't reach the level that analysts have expected. Does this make sense? 80. But note again that this webinar is on technical analysis. If you are good with technical analysis, here is simply a resistance level, okay, that during NFP it just broke. It was just smashed through. Okay, so this could potentially could be an entry level or something else. If you know technical analysis, this is also a support level. That could be maybe a stop loss, or maybe too far from someone. Are there any more questions? I can reply. What time do you suggest? What time frame do you suggest to take a position? Well, at Deepak, it really depends on your strategy, on your style, on your experience, how much time you have during the day. Do you trade during the day, during the night? So it's a very, very generalized question, but mainly just to give you an idea, I always use the 1 hour time frame when I look at the markets. They give you the best perspective, short and long term. Okay, when you want to enter a position, then it's better if you go down to the 15-minute chart, so you can identify a very good entry level and draw your stop loss and take profits. You're welcome. Any more questions? I will allow a few more questions within the next 2 minutes. If there's anything else to ask, please feel free to do so. So you see my charts are always like this. I use the RSI, the MACD, and sometimes I bold the Bollinger Bands there too. But in most cases I don't, because I can use my eye is so used to it, I don't need to use them anymore. Thank you. It was a great session, Fayaz. Fayaz, you're welcome. Thanks for attending. I hope it was helpful and useful. If you have any questions, any of you guys, don't forget that you can email me if you remember something. You can email me at my email address. I will show that at the end of this webinar. AT, another question. Is it better to trade on bigger time frames and avoid intraday trades? It really depends on your objectives, AT. If if you are getting mentally stressed with trading during the day, and or maybe trying to find opportunities during the day, then of course it's best if you go into the longer term and look at entering maybe 1 or 2 trades a week or every 2 weeks or so. There is a lot of aspects that you need to consider, including the psychological aspect, of course. It's all about you. Okay, you might know everything about indicators, about the markets, about strategies, but if you are not in the right mind state to trade, you will unfortunately not succeed. So you need to make sure that you really making the best situation of and creating the best environment for you to trade. That includes creating a strategy. Make a strategy that fits your personality traits, that fits your requirements, your objectives, your time at home, your time at work. If you work, it's very important. Technical analysis, though, is the 30% of trading success. 30%, 60% to 65% is your psychology, and 5% I would say is luck. You need a bit of luck too. So I'll wait 1 more minute for a last question if there is no more questions. And fundamentals, yes, of course, they are important, the fundamentals, but as I said, they are part of technicals. Okay, so I will consider this as a 180. How to best identify entry levels? You said just on 15 time frame. Are there any other methods? No, what I'm saying, Felix, is not about identifying entry levels. You need to have a strategy, a rule, a set of rules to identify opportunities and identify entry levels. But you would have to go down on a 15-minute time frame to make sure you get into a good level and you don't miss not even 1 pip, okay? Because you need to look at the markets in a very short time frame to when you have already identified the opportunity. Okay, Felix? Okay, as I said before, this is you're welcome, Felix. As I said, this is my email address. If you are watching this, if you will watch the recording, feel free to email me if you have any questions. If you have forgotten anything that you to ask, then again, feel free to do so. Okay, so thank you for attending. I hope the session was useful for you. You're welcome, Deepak. And I will see you in our next session. Don't forget, we also do the monthly NFP webinars. They are becoming very successful. All the attendees are very happy with the analysis and also with the levels I provide. So don't forget those as well. And we will provide this recording online on our YouTube channel. So keep an eye on that as well. Thank you very much for attending once again, and have a great day.